I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a real treat. We have a former White House budget director in the Reagan administration, David Stockman. Also, a former congressman. Is a financial expert, knows all about big numbers. Also has his very popular blog, David Stockman's Contra Corner, which has some free stuff and subscriptions. We'll talk about that at the end. David Stockman, thanks for joining us today on USAWatchdog.com.
Happy to join you, and there's certainly a lot to talk about as we peer into the next year in the midst of all this craziness that's happening both in Washington and on Wall Street.
Well, the tax cuts and the all this money flowing back into the country, done deal. What's your appraisal of this tax cut? I hate it that they didn't cut anything; they just cut taxes and borrowed money. But I'm not you. What do you think about that tax cut plan?
Well, I think it's going to be a fiscal calamity of biblical proportions. Now, I want to be clear. I'm always for tax cuts and shrinking the size of government, but you have to earn it. You have to cut spending and reform entitlements and pull back this massive defense budget if you're going to have tax cuts as well. Obviously, they didn't do that. This bill will add, if you look at honest accounting and drop all the gimmicks and sunsets and other unrealistic mechanisms that they have in the 10-year period, this bill will add $2.5 trillion to the public debt, which is already, and this is the key point, is already going to rise by $10 trillion over the next decade based on the current law, taxes, and spending that's built in. Now, even more importantly, they have this front-loaded, which I think is the real danger. The biggest tax cut is in 2019, fiscal 2019, which is starting, 9 months from now. It's $280 billion. There's no way they're going to earn that back with growth in the next 9 months. If you add on top of that huge hole of $280 billion, the $75 billion they've already approved for defense increases, the $81 billion that they just passed yesterday for the disasters, the hurricanes and wildfires and so forth, on top of $50 billion that they've already enacted. And then you add the money that's been offered in the Senate to pass the tax bill. And, this is all under the table and sort of off the screen in terms of what's being counted. But the only reason it's going to pass the Senate is, among others, Susan Collins, the senator from Maine, is voting for the tax bill because she was promised in ironclad terms by McConnell that they will bail out Obamacare by funding the $20 billion a year bailout to the insurance companies. So that's coming on top of everything else I've mentioned. Now, when you recall, there's already built in for the coming fiscal year we're talking about here, 2019. When you recall, there's already $700 billion built in. You add the $280 billion tax cut, $200 billion of all these different spending increases that I mentioned. You're facing, and not in the distant future, not in the by and by way down the road, but in the next fiscal year, a $1.25 trillion deficit, 6.1% of GDP, at a time when two other notable things are happening. One, that will mark the 10th year of the recovery, which is the longest on record. And the last time that you want to be massively increasing the deficit is when you're at the very end of the road on a business cycle expansion and heading, for the next recession that sooner or later will come. And then the deficit will really explode. But secondly, and more importantly, the central banks of the world and the Fed leading the way have finally realized they can't keep printing money at these crazy rates. And by that, I mean the bond buying. And now they're going to begin to normalize and shrink their balance sheet. The Fed has already started that process. By spring, they'll essentially be dumping 350 billion of bonds at an annual rate onto the market. And by the fall, when the next fiscal year, begins, that we're talking about here, they will be shrinking their balance sheet by 600 billion a year. And what that means in plain, simple English is that they're dumping 600 billion of existing bonds into the market, just as Uncle Sam will be attempting to borrow what I've just described, 1.25 trillion more. Now, if you don't think that is a financial collision waiting to happen, then I'm not sure, what would be. We're really heading for, a thundering collision in the bond market that will drive yields, upward far more than the market is expecting. And since the whole artificial stock market today is based on, the illusion of permanently low, ultra low interest rates, when interest rates start to rise, everything is going to come apart because cheap debt is priced in forever, and we're heading for far more expensive debt as a result of this fiscal collision that I've just described.
Are we going to have inflation or deflation or both?
Well, I don't know. We've had enormous inflation already in the last 6 or 7 years, but it showed up not in goods and services pricing, but in financial assets. After all, the Russell 2000, which is the index for the Main Street small and mid-cap companies of the United States, hit 550 on the index yesterday, compared to 350 way back at the bottom in March 2009. So we've had this huge inflation of stock prices, of bond prices, of any kind of so-called risk asset, and yet that doesn't get counted in the official inflation measures. So I don't think it's a question of inflation or no inflation. It's a question of where it shows up. And I think we've had so much unsustainable inflation in financial asset prices that the deflation that I think you're hinting at, is going to occur in the canyons of Wall Street. Bond prices are going to collapse when yields begin to rise under this pressure that I've just described. Stock prices are going to collapse big time when the underlying predicate of cheap debt forever and the massive stock buybacks and M&A deals and everything else that's supporting the market today finally reverses. So we're going to have deflation in the canyons of Wall Street, and that will not be a happy day for anyone.
I just had Martin Armstrong on, and he agrees there's going to be a massive debt reset. I mean, we have Federal Reserve notes, our dollars are debt. Are you talking about that when we have a debt reset, we're going to have a dollar reset as well?
Well, the dollar is probably the cleanest dirty shirt in the laundry. The rest of the world is worse. I mean, if you look at what Draghi's doing today still in Europe with the ECB, not yet ended its QE. It's still buying 30 billion a month. It's got its balance sheet bloated to nearly 5 trillion, or almost 50% of GDP in Europe. So I think if you look at what he's doing, if you look at the crazy people that run the Bank of Japan, where they have their balance sheet at nearly 100% of GDP, I don't think the dollar is necessarily going to crash. I think what's going to reset is financial asset prices. In other words, the Treasury bond today, actually the 10-year went up a fair amount. I think that's one of the things that spooked the market. But in any event, when it goes from 2.44% yield, where it is today, to easily 4% or higher, that's a 30 or 40% drop in the price of that bond. And since the Treasury 10-year, is the reference price for all the fixed income debt of the world, including debt in all the other currencies, you can imagine the multi-10 trillions worth of reset in a downward negative direction that's going to hit the bond market of the world. And there's no way that all of these day traders and robo machines that are pumping up the stock market today are going to be able to, keep the bubble expanding or even stable in the face of this huge, huge reset in the bond market.
Oh, I ask this all the time, and you're a down to earth guy, and a lot of people love and respect you. I do. You're a smart guy. You've been around the block. You know big numbers. But if you could shrink it down to the little guy, the man, when you say the bond market is going to explode, interest rates are going to go higher, assets on Wall Street are going to shrink, they're going to go down, bond prices are going to get cut in half for 40%. What does it look like to the man on the street? What's the guy on the street going to see?
Well, the guy on the street has been punished pretty badly already because, for one thing, if he's prudent at all, he's attempting to, save for retirement, save for the education of his kids, save for a rainy day for his family. If he's been doing that, he's basically, been savaged by interest rates that have been forced into the market by the Fed that have essentially been at the zero bond for almost a decade. Now, at least one piece of good news is that people that are trying to be financially prudent and save are going to at last begin to earn some kind of yield, some kind of return on savings if they want to be prudent and not jump into the junk bond market or chasing the Russell 2000 or the FANG, so-called, or Amazon or Netflix or any of the rest of them. Now, on the other hand, I fear that, like usual, the home gamers, as we call them, the retail investor who's been, nailed by all of this financial turmoil of the last 17 years, is finally forgetting the lesson they learned when dot-com crashed and the lesson they learned in 2008 when they said it was a Goldilocks economy and stocks could never go down. In the first instance, the NASDAQ went down by 80%, as you remember, when dot-com crashed. And then in 2008, the S&P 500, which is the big stocks, actually went down by 60%. So what I'm saying is people thought they learned the lesson, but now in the last year or two, as we've reached the, peak or the asymptote, you might say, of this third great bubble, it looks to me like the home gamers have been suckered right back into the market again, like sheep being called to the slaughter. And if they're in there buying this market at 2,650 or pushing 2,700 or the Russell, where I mentioned a moment ago, they're in for the third nasty shock and loss of this decade. So it's still not too late. There's nowhere to go but down from here. And, hopefully people would understand, get out of harm's way. The casino is unstable. It's at a roaring peak, and the risk reward is just terrible. Little more upside, and dramatically a lot of downside.
People like Martin Armstrong say all this money is real. They're going to bring it back. A lot of it's going to go into stock buybacks. That's going to turbocharge the markets higher. You called for a crash in October or November. That got pushed off. I think they didn't think that the tax cuts were going to go through. They're going through. What do you think this market is happening? Why was it pushed back from October to November? As I believe you, and I still believe you that it's this hinky, weird going on. Why do you think the market got pushed into 2018? You think the stock market the crash that where you're talking about the bond market. If the bond market, I'm sorry, I'm so excited to have you on. If the
Yeah.
bond market goes up, if interest rates go up and crashes the bond market, you're
Yeah.
saying game, set, match on the stock market, bond market. They both go down at the same time. You think that happens in 2018?
Well, look, I think so, but on the other hand, the stock market has been a disaster waiting to happen for a long time. In other words, there's no rationality left. There's no price discovery. This is all just momentum trading based on the enormous liquidity that's been injected by the Fed and is still being injected into the financial system by other central banks, but in rapidly diminishing amounts. You know, the ECB just announced this week that they're dropping from 60 billion a month of bond buying to 30 billion, and that that money circulates. It's all fungible in the entire global financial system. So there has been at least a little bit of support on the margin. But what I'm saying right now, the market is just trading on pure price action. People are buying because it's going up. It's pure momentum. There is not any regard for fundamentals. And so with the right catalyst or black swan, whatever you want to call it, I call it the orange swan because I think Trump is leading the way to disaster on fiscal policy. But whatever you want to call it, this market, can roll over when the right feather sort of lands on the pile. And I think that is going to be when it dawns on the bond market and the stock market for that matter, that yes, most of the corporate tax cut will flow back into stock buybacks and enhanced dividends, and that's what some people are looking at to support the market. But on the other hand, it's all going to be borrowed money. Every single dime of it is going to be borrowed by the U.S. Treasury on top of what I just described earlier on in terms of all the defense money, the disaster money, domestic appropriations, the insurance company bailouts, and so forth. So when they begin to realize that the Treasury is going to be in the market for $1.2 trillion and that the Fed is sticking to its guns, and I think this is an important thing. Janet Yellen in her swan song a couple of days ago said, we are so on automatic pilot in terms of shrinking our balance sheet, which was 10 billion a month this quarter, 20 billion a month next quarter, and so on, that we're not even going to mention it anymore in our post-meeting statement. Now, that may sound a little obscure or subtle to some people, but actually it's a huge statement. It's a statement that we're shrinking this balance sheet, and they call that allowing their balance sheet to run off. But don't have any illusion when they don't replace retiring, maturing Treasury debt or Freddie Mac, Fannie Mae debt that they own. That's the same thing as selling the bond, because the Treasury will be back out there in the market to replace every dime of maturing debt. So they're going to be, this is critical, big time dumpers of bonds on the market, like has never happened in history really, but certainly not in the last 30 years, where the balance sheet, ballooned from 200 billion to 4.5 trillion. For the first time, they are pivoting, and they're pretty serious, I believe, into a huge bond selling campaign that will run smack into this massive Treasury borrowing. That is what they call not priced in, not even, for a moment, because today's markets have been so spoiled by central bank, price keeping, as I call it, stimulus, whatever you want to call it, that they're not looking ahead. The markets aren't discounting any real assessment of the future. They're just waiting for something to stop them from going up. And that something is what I've just described, the bond market collision that's coming right at us as we move into 2018.
How fast could interest rates go up, and how high and how fast can interest rates go up?
Well, they could go up pretty fast because we've seen a very volatile bond market over the last 4 or 5 years, even though the Treasury 10-year stuck in the sort of, excuse me, 2.35% range now for a month or two. But it's actually swung from a high of 270 in 216 in the summer of 216, to a low of 1.34%, not too far back. So what I'm telling you is, once this starts to move, you have to realize that this bond market is full of front runners. In other words, it's full of people who were buying the bond on repo, which is to say leverage. You buy $1 billion worth of bonds and you borrow $900 million against them from the Wall Street dealers. They've been buying bonds, the government bond on repo, because the yield spread was enormous. It was just like printing money. You borrow, overnight for, let's say, 30 basis points, and you harvest a yield of 230 basis points, and that seems like free money. But when bond yields start to rise, here's the key point: this huge front-running arbitrage that's in the market now is going to unwind. People will sell their bonds, liquidate their repo borrowings, and who's going to buy the bonds? It was the Fed, but they're getting out of the market. They're going to be selling. It was the ECB, basically indirectly inducing European bond investors to buy treasuries, U.S. treasuries, dollar-denominated debt, because they drove the yields in Europe to such a low point that it was ludicrous. In Europe today, actually, junk bonds, if you can believe this, issued by, companies in Italy and other places, dodgy companies in Italy and other places, the yields on junk bonds are below the 10-year U.S. Treasuries. So what I'm getting at here is as the ECB finally gets over this bond buying mania. In fact, Draghi's term is ending next year, and I think they'll put a German, more sound money type in as head of the ECB. But when you get the ECB out of the market, Japan has even announced they're slowing down. China is drastically throttling back the rate of monetary expansion now that Mr. Xi has been coronated as ruler for life. When you factor all those things in, you get a picture that could see bond yields jump by 50, 100, 150 basis points within a year or less. And let me tell you, that would be a shock to the system, because all these U.S. companies that have borrowed upwards of $6 trillion over the last 10 years to buy back their stock, are going to suddenly find that they're paying a huge premium on all that debt, and their earnings are going to be clobbered accordingly. As a matter of fact, I'm writing in my blog for tomorrow that there is now 12.5 trillion of debt on businesses in the United States. Corporations, about 8 trillion, and the so-called pass-throughs that we've been hearing so much about, unincorporated businesses, partnerships, subchapter S, and so forth, 4.5 trillion. So my point is that if we get even a 200 basis point normalization, which I think is very possible, in other words, a 10-year trading at not 2.3 but 4.3, which is still low by historical standards, you would have a 250 billion reduction in pre-tax business profits in the United States. I mean, that isn't priced in. That's not on the radar screen, let me tell you, of the day traders on Wall Street. So the short answer is it's going to move up in 100 plus basis points, and that is going to clobber everything that's built in, priced in, and predicated in the bubblish markets that we have going today.
I mean, you're telling me that the picture you're painting, I'm getting from you, is the whole thing could just implode, freeze. The whole thing would just freeze. People wouldn't be able to pay. Businesses would not be able to pay this back.
Well, I don't know if the whole thing is going to freeze. There's massive liquidity in the market. After all of this money printing by the Fed, after all, remember when the crisis happened last time, the balance sheet of the Fed was 900 billion, let's say. Now it's 4.4 trillion. Well, they just printed liquidity. They bought bonds and put new money into the system. It's still out there. It's sloshing around. There's something like 10 or 12 trillion of bank deposits in the country. So I don't think it's necessarily going to be a liquidity crisis. I think it's going to be a value reset. I think it's going to be a jarring downward price adjustment, both in the stock market and in the bond market, and the sort of phantom or phony wealth that's been created by this huge bubble since the last crisis is going to obviously, evaporate. Some people forget, and I think it's another important big number to kind of focus on. After the last crash, the net worth of U.S. households, which is published by the Fed, and it's an estimate, but it's based on the market value of all the residential houses in America owned by households, 80 million, and stocks and bonds and bank deposits and all the rest. But my point is, it went from 55 trillion at the bottom, and that wasn't that long ago, June 2009. Everybody thought the world was ending. To 97 trillion just reported in the most recent quarter. Now, my point here is that there's massive amounts of bottled air, of phantom value in that huge increase as a result of interest rates being so low that real estate is massively overvalued. And because of the Fed's huge stimulus, stock prices are, exaggerated enormously by 30 or even 50%. So when you wring all of that excess, all of that bubble finance, as I call it, out of the 97 trillion, you're going to have a multi-10 trillion drop in at least reported household net worth, and that's going to set the economy on its heels for many years to come.
And would you be a buyer of gold if the bonds get cut in half and the value gets cut and the stock market gets cut in half? Gold's been the redheaded stepchild since at least 2011. Would you be still a buyer of gold and silver, physical gold and silver?
Yeah, I think the time right now is ideal. Gold is the ultimate and only real money. It's the only safe asset when push comes to shove. I mean, they tell you on Wall Street, buy the government bond, that's a safe asset. It's not a safe asset at its current price. I'm not saying the federal government's going to default in the next 2 or 3 years, but I am saying a bond, a yield on a 10-year debt of 2.4% is way below where it's going to end up. So the only safe asset left is gold. And beyond that, with this crazy Bitcoin mania that we have going today, that has drained off a lot of what would otherwise be the demand for gold, because there are a lot of people who don't are not drinking the Kool-Aid coming from Washington and Wall Street. But when Bitcoin collapses spectacularly, which it will, I mean, it's just sheer mania out there in those markets right now. When it collapses, I think a lot of that natural demand will come back into gold, as well as people fleeing the standard stock market and bond market for the first time in 9 or 10 years. So I see a confluence of developments of demand for gold that should send the price soaring. And I would think now is a pretty good time to start accumulating.
And for the poor guy, just real quick, silver would be a good deal, cheap insurance, 18, 16, 16, $17 an ounce, whatever it is right now.
Well, I think it does trade relative to gold, not consistently, but in a general way over time. So yes, but silver isn't cheap. I mean, it's just priced differently per ounce. But if you've got $10,000 to put in a safe place, put it in gold or silver, not in the Wall Street stock and bond market.
Okay, good deal. And real quick, I just wanted to bring this up because a lot of people ask me. I wanted to get your brain on this. I know this isn't part of your bailiwick, but I know you know big numbers. Dr. Mark Skidmore was on my air and talked about 21 trillion. Got it from government reports, which they de-linked to, but they put them on Solari.com. Catherine Austin V, you probably know who she is. But 21 trillion they can't find in HUD and Department of Defense. They just sparked a big audit at DOD. Just your thoughts on the 21 trillion missing money on top of the 20 trillion that they say we owe already. It just sounds crazy to me.
Yeah, well, I don't doubt it at all. When they talk about draining the swamp, the deep end of the swamp is on the Pentagon side of the Potomac River. There have been audits done in the past, even before this one, that suggest there's something like 150 or 225 billion a year of waste and inefficiency in the DoD budget right now. And it hasn't been really thoroughly and systematically and honestly, audited for decades. So I can imagine what they'll find. But my point is, they're now adding, because Trump's got this crazy idea that he's going to make, America strong again on defense, which is crazy. We got 10 times more defense than the rest of, any other country in the world. But they're raising the defense budget by 75 billion this year alone. That is making the swamp that much deeper, the waste that much more dramatic. So I don't know if the number you're talking about is 20 trillion or some other number, but I do know this, that you have so much momentum built in by the military-industrial complex. And we have a whole sort of neocon war party apparatus in Washington that can't seem to keep us out of anybody's business anywhere in the world, and has us in the middle of this totally unnecessary confrontation with Russia. They're no threat to the United States. It's kind of a pipsqueak economy with no serious military threat. But in any event, notwithstanding all of that, there's huge momentum behind the defense budget. There's obviously the whole entitlement system and all the unfunded liabilities for, Social Security, Medicare, and all the rest. Some people say that's 75 trillion or more. So my key point is we're heading into the 2020s. That will be the peak of the baby boom retirement process. They're going to be retiring at 10,000 a day. There are, at the present time, about 60 million people on Social Security, retirement, and disability. By the end of this decade, the 2020s, there will be 85 million people on those retirements. All of that cost is going to, increase dramatically. And if you put on top of that the reckless fiscal policy that the Republicans and Trump are now putting into place, and the fact that sooner or later we're going to have a recession. I mean, nobody abolished or outlawed recessions for the rest of recorded history. So when you combine all that, you have a fiscal disaster coming down the road in the next decade that, as I started our discussion today, is truly epic proportions.
Talk about your website, David Stockman's Contra Corner. You're a prolific writer. You write almost every day. Some of it's for free. Some of it's for pay. I can't imagine that somebody really wanted to know what was going on in the crazy world we live in wouldn't pay to subscribe it. Talk about your David Stockman's Contra Corner and the free side and the pay side.
Right. Well, that it comes out every day. It's called David Stockman's Contra Corner. You can easily get to it by Googling that. And I post every day commentary on the fiscal situation on Wall Street, on what's happening in the international financial system and economy. I address the uh, just absurdity that's going on in Washington with this Russiagate witch hunt and the growing incapacity and dysfunction of what I call the imperial city. That's really what Washington is. It's kind of imperial Rome in modern garb. So I talk about all of this, and then we also post about 10 reads each day from other authors on these topics that I think, are pertinent or salient or informative. Now, the subscription rate is about $30 a month. That's $1 a day. It seems to me that that's pretty reasonable for everything you're getting.
Well, I think it's reasonable too. You're a very smart guy. Thank you for coming on, David Stockman, former White House budget director in the Reagan administration, former congressman, a financial expert. Now with David Stockman's Contra Corner. For you folks there on YouTube, you go back to my all links are found on, and I will put you back to the USA Watchdog site after the interview section. You'll find David Stockman's Contra Corner, the homepage, and also the subscription page. David Stockman, thank you so much for joining us today on USAWatchdog.com.
Very happy to be with you and look forward to the next conversation.
Yes, sir. Thanks for being on. You're very enlightening. You got a big brain, and we'd like to see it on parade. Thank you, David Stockman.